The Finance Act that was gazetted end of the year, it actually did not change or it's not aligned to what the Minister of Finance said, that individuals will now enjoy the exemption, right? It still says the old announcements. So stay tuned. We'll be updating more. As of today, it is status quo, as in the minister has made that statement. We have also read that the exemption will only last for 5 years. So we are waiting for further clarification. All right. So scope of taxation also means that as long as you're having and exercising an employment, I don't care where the payroll is paid, right? It doesn't matter. It's not that all payroll must be caused through the local entity. It can be paid offshore. In any case, if it's in relation to your employment in Malaysia, it will be subject to tax in Malaysia. All right. Basis year, I think everybody is very familiar. It is from 1st January to 31st December. And the filing deadline, as of today, it is 30th April. We do have a normal concession up to 15 May, right? For those who have business income, it will be on 30th June. But generally, many who are on employment basis, yeah, it will be on 30th April. Okay, let me move to the next slide, please. Now, on employment income, like I said, whatever is that source or derived, so as long as employment is exercised in Malaysia, as long as, even if you have leave for that period that's attributable to exercising that employment, if you should even perform your work outside of Malaysia. This is an interesting point. Just yesterday, we had a discussion. One of the clients was asking us, hey, Weina, we've got some of our employees, they are Malaysian employees, and part of their role is actually to go offshore, to go outside of Malaysia, to perform certain of the servicing, right, outside of Malaysia. And then when they go outside, they would also be getting additional allowance. Now, the question was, will they be taxed on that additional allowance because of the fact that they were working outside of Malaysia? Now, go back to the primary principle again, right? Where is their employment? They are still with the Malaysian code. What is their role and duty? It is not only doing work in Malaysia, and on certain occasions, they will still have to go outside of Malaysia. And therefore, it is part and parcel of their Malaysian employment. Therefore, any additional allowances that were paid to them, it will be subject to income tax in Malaysia, right? Now, we also caution them, hey, how long were they outside of Malaysia? Because bear in mind, there could also be income tax implication in that country outside of Malaysia. So there are facts and more facts that we need to explore, but be mindful of these similar circumstances that you may have as well, right? Now, a person who is a director of a Malaysian company, resident company in Malaysia, gets director's fees, would also be subject to income tax in Malaysia. And mind you, sometimes there could be foreign directors that sit in the board of in the board of the local companies and receiving director's fees just because they are residing outside of Malaysia, but the fact that they are receiving director's fees from this Malaysia code, and therefore having an appointment with this Malaysia company, Malaysia income tax will still be levied on those director's fees. So be careful on that as well, right? Now we move to the next slide, please. So I've spoken on the basis of taxation in Malaysia. We talked about the sources of income, and what you see here are generally very, very common ones that a typical employee will get, right? Or even expatriates for that matter, that you get the benefits in kind, whether it's accommodation, motor vehicle. Just want to emphasize a little bit on sometimes there could be split payments, and therefore if we can move to the next slide, please. Right. What we see sometimes that have been missed or omitted in the declaration is this equity income, i.e. incentives, share incentives, equity incentives that you receive from the parent company or within the group of companies. So a lot of misunderstanding would say, hey, Weina, the shares did not come from the local company. It came from the parent co overseas, HQ. It could be your French headquarter. But the fact that you have received such incentive in respect of your Malaysian employment, this is considered part and parcel of your employment income to be subject to tax in Malaysia, right? Another point to note in terms of equity income is how do you actually value those benefits? And these are some of the guidelines. Fair market value, again, a very commonly error that we see in terms of valuation of those share incentives. A lot of people will say, oh, I follow the share plan and it's based on the value of the closing date. Yes, policy is as such, but the inland revenue, look at the note here. It actually takes that definition where it takes the value of fair market value as the average of the highest and lowest price on the day concerned. Okay? So be very careful. Share plans can come in many forms. It could be free shares, it could be share options, it could be restricted shares. So when does that tax liability trigger? When will it be triggered? The time where you are the legal owner. It doesn't matter that you didn't sell it. We do not have capital gains tax in Malaysia, right? But the moment you are vested, the moment you are legal, even though you did not sell it, a legal obligation has arisen. You have gotten a perquisite, as what is said, per the Income Tax Act, and therefore Malaysia income tax will be subject and levied on those equity income, right? And we move to the next slide, please. Okay, so this is where I've indicated as in no capital gains tax, and when would you be taxed on the day where you are legal owner to it, and might be mindful of the definition of the fair market value for income tax declaration purposes. Okay, all right, we move to the next slide, please. So much so for knowing what are the income that we need to declare, but very important is to making sure that we actually have completely and correctly declared them. So I mentioned about split payrolls. You could have part payroll in local company. You could have another payroll outside of Malaysia. As long as all of this is in connection to your Malaysian employment, this will be subject to tax in Malaysia, right? It could be past salaries that were not paid. It could be trailing income. Yeah. Sometimes after you have left Malaysia, and then there could be bonuses that came that is paid to you after you have left Malaysia. That itself would also still be subject to Malaysian income tax. All right. I spoke about directors' fees as well. Be mindful about that. Allowances is the same whether it's paid in Malaysia or paid outside of Malaysia. And tax borne by the company itself, we've got a tax on tax regime in Malaysia, and therefore this needs to be accounted for as well. Okay, now we move to the next slide. So we've covered the basis of taxation, territorial base, source in Malaysia. We spoke about the scope, the types of income, this tax resident status. Now, if indeed, let's say we're the Minister of Finance during the budget speech, where they mention about non-resident, that would only enjoy the exemption. But now with the new statement that he has announced that this exemption clause would apply again to individuals, then you will say, so what is so great about knowing what tax resident is? Now, prior to all this, everybody wanted to be tax resident. Why? Because you are levied on a tiered scale tax rate, right? If you are non-tax resident, then of course you will be taxed at a flat rate, and currently it is at 30%. Okay, so how then is determined on whether you are a tax resident or not? Basic physical presence, the number of days you are present in Malaysia in a calendar year, right? And if you qualify as a tax resident, then you can enjoy all the deductions of the tax relief, which I will cover. if you are non-resident, you cannot enjoy. All right, let's go to the next slide that you can have a glance on the rules. Right, we've got under section 7(1)(a) to D, as you can read, that this itself, if you meet either one of it, right, you will then qualify as a tax resident. Okay, now with that, if let's say, like I mentioned earlier, if you're a tax resident, then what are the kind of tax reliefs that you can enjoy? So be mindful that we're going to file in our 2021 tax return already by 30th April this year. Let's have a look at it in the next few slides then. Move to the next slide, please. We've mentioned that. All right, so just before I move to the next resident, just a reminder, right? Prior to you leaving the country when you finish your assignment, one of the procedures is actually to validate your tax resident status. Now, be mindful that it is a self-assessment tax regime in Malaysia, which means whatever you submit, right? If you regard yourself, and this has not been validated by the Inland Revenue at all, and it will only be done when you leave the country. So if you say that, oh, I think I am, but you did not check carefully, and then you chose the resident tax return form, which is the form EBE, right? And let's say prior to you leaving, this verification of your tax resident status is a mandatory process at the Inland Revenue, right? And if the Inland Revenue checks through from the time you arrive until your planned departure and sees that, hey, you actually did not meet any of the criteria in that section 7(1)(a) to D that I mentioned earlier, in fact, they can actually penalize you for submitting a wrong tax return. They can actually penalize you for filing. Let's say you have been filing a tax resident, which means you use the tiered tax rate, you claim tax relief, which means by virtue and when they check your tax residence, you actually were a non-tax resident, which means you have actually underpaid your taxes. So there are two penalties here: filing of incorrect tax return and underpayment of taxes. So be very, very mindful that you choose, or I think in the first step, validate your tax resident status first and ensure that you do this procedure of verification before your departure. Because any missing of this procedure, the Inland Revenue has every right to relook and reassess your tax return, even though it was submitted as a tax resident, right? They can actually reassess you as a non-resident, and therefore with the penalties and additional tax to be paid, not a very nice goodbye, farewell, but this is something that we think that you need to be mindful of. And many have actually omitted on this, especially where they take care of their income tax compliance on themselves. All right. Okay, let's move to the next slides. So I mentioned about the tax resident status. If you qualify, these are some of the tax reliefs, which I'm sure that every one of you would be very familiar with. So just a quick refresh, and those that are marked star, which we think that it's very commonly claimed by the expatriates in Malaysia. You have, of course, the automatic self relief at 9,000, spouse where it's not working, and for children as well, right? The next slide, please. And of course, medical expenses, if you actually incur on your own, but we have seen a lot that actually a lot of the medical expenses have been taken care. But for some, where you take care of your own medical expenses, be mindful that in 2021, there are actually additional claims, or rather the scope of claim has actually been extended. That you can see here that it's actually accounting for vaccination, yeah, and also mental health checkups as well. Okay, next slide, please. And of course, not forgetting for those of you who contribute to the Malaysian EPF, Employee Provident Fund, or you take up your own life insurance or medical insurance, education insurance, all of this are claimable as well. Now, again, the budget also announced effective from year of assessment 2022. Okay, that is next year's tax return. They have actually included the tax relief where you incur expenditure on charging facilities, to promote electric vehicle. All right. Okay, and we have the next slide. And also lifestyle reliefs, there are additional ones. Again, additional 2,500 from the usual one that you're familiar with. This is again for any purchases that were made for computer, smartphone, tablets from January 2021 to 31st December. Then you have that additional 2,500. And also trying to spur up domestic tourism. Again, that you have your staycation and all that last year, there is the additional 1,000 that you can claim. All right. Move to the next slide, please. Okay, so the tax clearance, as I've mentioned, do not forget that you actually need, the employer actually need to file a notice and making sure that a notice of submission will be made at least 30 days before the expected date of departure. All right. And then again, where tax is borne by your own, the employer actually have an obligation to withhold the last month pay, to making sure that you actually settle the taxes in final, right? When you have your tax finalization. All right. Okay, we move to the next slide, please. So covering all to making sure that you have indeed understood from the time that you have arrived, what are the income that you need to declare, be mindful of your tax resident status, what are the tax reliefs that are available. I think the last note that I wanted to leave with all of you is this automatic exchange of information. What does this mean? This is since 2018, where if you have financial accounts outside of Malaysia, there is actually this exchange of information between tax authorities, yeah? And this is under the common reporting standards, that's under the OECD protocol. What it means is that the Inland Revenue in Malaysia actually will have information of what your accounts, your investments are outside of Malaysia. There are close to 100 and I think 50 or 50 over countries that are participating in this. At the end of the day, what does the Malaysia Inland Revenue want to know? They actually just want to know is, oh, okay, if Ms. Ang, you have X amount of income or investments outside that we can see from the Malaysia, from the, say, foreign bank account. All they want to know is from what you have declared taxes or declared income in Malaysia. Does those investment actually look reasonable, right? They want to make sure that you have indeed filed all Malaysian sourced income in Malaysia. File income tax, okay? If you remit it outside, that's fine, as long as you have filed it. They just want to make sure that they do not miss any of the Malaysian source income that you did not file taxes. And therefore, since last year or the year before, if you could recall from the income tax return form, this is where we have highlighted here. They have actually asked you, do you have any financial accounts with financial institutions outside of Malaysia? All right. If you say, no, I don't want to tell them, you put no, the exchange of information, the Inland Revenue will still know. Okay, so be very careful on that. The next slide, please. So this is where, to just as an illustration, to letting you know the exchange of information that comes from the financial institutions, it goes up to the tax authorities, and the tax authorities actually exchange on that. So in a nutshell, you can actually see this, okay? And what are the kind of information that they exchange on? The next slide will share with you. Let's have a look. Right. So in terms of your tax ID number, account information, and you can see the whole list of this, yeah, that they actually share. And you probably recall the foreign bank institutions actually have sent you letters. I personally have received. I've worked in Singapore before, have my Singapore bank account. The Singapore bank actually have sent me and said, Ms. Ang, can you reconfirm your tax resident in Malaysia because of this? And therefore, and it is because of the common reporting standard that all foreign banks or banks likewise will have to make sure that they get a confirmation from non-resident bank holders, yeah, and then to see where indeed such information should be exchanged on. All right. So with that, ladies and gentlemen, give you a good overview of what you need to take note as an expatriate in Malaysia, mindful of AEOI. Immigration, really, I would say a huge change, very, 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 really keeping you, I think what Cynthia is going to share with you certainly will be what are the latest today. All right, so with that, Cynthia, I hand it over to you.
Thank you, Weina. Hi, good afternoon, everyone. Today, I have a couple of updates and also sharing with everyone about what is the most recent popular immigration passes suitable for expatriates. What I'm going to cover today is about the latest requirement about the in and out for our expatriates in Malaysia since COVID time. Secondly, I would like to share, Mr. Lozat has briefly mentioned in his beginning opening speech that he was part of the members witnessing the opening at KLIA. What does that mean? What is it about? And lastly is about the most popular, which we are handling with our clients recently, about the short-term business visit to Malaysia. Okay, if you can look at the next slide. This is the My Entry latest requirement that I would like to share with you all today. This is a requirement or a product since COVID. Pre-COVID, anyone, including expatriates in Malaysia, so long they have the valid employment pass, work permit, endorsement on passport, then did not have to ask for any permission to exit and then re-enter. And for the first timer, they did not ask the additional permission to enter Malaysia. Then we had the lockdown since last 2 years, and that the government has actually imposed that everyone, including the expatriates, needed to have the approval to come in, to leave, and re-enter. The good news is effective November last year, this requirement has been relaxed, okay? And the examples that you can see today is who will have to get this My Entry approval. Any expatriates together with their family members who already have the valid immigration pass endorsement on passport, in and out, coming in for the first time, no, in and out, they do no longer need the approval to do so. The one that still require My Entry approval is those first timer or for any reason, change of passport or remain in overseas and then change of passport or renewal has happened in the country but pending the valid work permit endorsement on passport. All these individuals will have to get My Entry approval before entering Malaysia. So this is the category that currently still requires My Entry approval. We are hoping and also anticipating, just like any Malaysian citizens, this My Entry requirement will be exempted sometime in future. All right. If we can move on to the next slide. Okay, this is something that is very new, launched last month, December, in KLIA 1. We call it ESD Satellite Center. What is this about? Some of you who may have been working in Malaysia for some time, remember when you first came to Malaysia, you had to arrange with the relevant parties to submit your passport, so that the same passport will have to be taken to the immigration department to get a stamp. They call it sticker endorsement on passport. And it will take between a couple of days up to 2 weeks. And sometimes in the past, it may take up to 3 to 4 weeks. That was a painful process. And this new process, this introduction, for any first-time expatriates and their families, with approval, with my entry approval as well, entering Malaysia, landing in KRIA 1, they can get the sticker, the immigration pass endorsement on passport at the airport, KRIA 1 itself, within a couple of hours. And we have received feedback shared by the authority that the process has been smooth. And this is certainly a good news to all the expatriates as well as the employers in Malaysia. The other option is the delivery of endorsed pass, delivery of the sticker. If for any reasons, the sticker, the endorsement cannot happen in KRIA 1, then there is another option to choose for this delivery. And within Klang Valley, the delivery can happen within 3 working days after the request for this option is made successfully. And so is it applicable to all expatriate work passes? Unfortunately, not yet. This is applicable for expatriates working under the companies of ESD, my aspect. For those under the purview, the immigration in pass under the purview of MDEC, not yet. And we are hoping to see the standardization in future. Okay. And the last slide about immigration updates today is this short-term business traveler. Okay. I have put down 3 different immigration passes suitable for short-term business traveler. The first one, this existed even before COVID, professional visit pass. The second and third one, they are also introduced since COVID, My Travel Pass. And the last one is MIDA Short-Term Business Traveler. What I would like to point out today is that professional visit pass and MIDA Short-Term Business Traveler, the first and the third one, all right, they can be deemed as work permits for the holders to carry out work in Malaysia. Whereas My Travel Pass holder, they are purely meant for business visitors. My Travel Pass cannot be deemed as a work permit. Okay, and professional visit pass, who is eligible? Technical advisor who will remain on foreign payroll while on assignment in Malaysia, maximum 12 months, non-renewable, no dependents. All right. My Travel Pass is purely for business visit purpose, and the applicant cannot be holding any long-term immigration pass by Malaysia, issued by Malaysia Immigration. And the last one is the 14-day, maximum 14-day MIDA STBT, short-term business traveler. No quarantine compared to the other 2. No quarantine requirement is applicable. You can come in once approved, and maximum stay in Malaysia is 14 days. In lieu of quarantine, government will assign a liaison officer to be together with the business visitor throughout the business activities in daytime until the business visitor leaves the country. And this pass is suitable for potential investors, existing investors, business customers, technical experts. All right. And the last thing that I would like to share with you all today about immigration, this has got something to do with the latest announcement issued by ESD and My Aspect 2 days ago, which is in line with the announcement issued by MDEC also, that is about the visa with reference requirement. Some of you may have heard about this journey perform visa option. In fact, for a French national, for example, pre-COVID time, you don't need to get any visa. You can bring your passport, come in, get 90 days stay in Malaysia. When your employment pass application is approved, for example, you can also come in without having to get any single entry visa, calling visa, visa with reference. You come in, you give your passport. There is an additional stamp on your passport called Journey Perform Visa option. That was an option. However, since end of last year, this is no longer the option. For all visa required nationals, for the purpose of working in Malaysia, they will have to get visa with reference. Some people call them calling visa. And that could be a hassle to make an appointment with the Malaysian embassy in your residing country and then submit the physical passport to get the physical stamp on passport. That will delay the entire process further. Well, another good news is because of this implementation of a new thing that all visa national will have to come in with visa with reference, right? The immigration department has introduced e-visa, meaning you don't have to get the physical visa stamping on passport anymore after your work permit application approval and my entry approval. You will need to just log into the system, upload and key in the certain information, then that will be processed. Within 2 working days, you will be given an electronic e-visa approval. With that, you can come in. If anyone, for any reasons, enter Malaysia without this e-visa, visa with reference, what will happen? Not to land stamp may be given to the individual and may be deported. And for this e-visa application, that will involve the IP address tracing, meaning for applicants residing in Malaysia, Singapore, North Korea, and Israel, they are not able to access to the e-visa portal to request for an e-visa. All right, that's all about my immigration updates today. So before we pass on to my colleague Boon Siew to talk about corporate tax, let's see if there are any questions from the floor. Right, so feel free to ask if you have any questions about personal tax, about immigration after this. For now, maybe I can take this question. Does this e-visa apply to a situation where EP is granted and authorization of travel is granted? Okay, this e-visa is for one-time purpose before EP sticker, EP endorsement is granted, meaning first time EP application has been approved, my entry authorization to travel has been granted, but you have not completed the entire EP process yet because you need to come to Malaysia and get the sticker on passport for the first time. Yes, e-visa is applicable. Yeah, so this is the latest news that the e-visa facility has been introduced to everyone. All right, so I would like to pass on my time to my colleague Boon Siew about corporate tax. Boon Siew, over to you.
Thanks, Cynthia. Okay, maybe can we move on to the slide deck for corporate income tax, please? Okay, good afternoon again, ladies and gentlemen. I am Boon Siew. So for my side, I have about 11 slides. covering the key corporate income tax updates for 2022, further to the budget announcement. And I should take about between 20 to 25 minutes of your time. So request for your, again, unwavering attention throughout this period. Okay, so this first topic being the tax on foreign source income, or FSI, received in Malaysia by tax resident persons. I think my partner Weina has briefly covered it in her portion of the presentation. For this, in the next few slides, I will go into a little bit more details on this, and also how it impacts corporates in Malaysia specifically. If you ask me personally, I would say that this is the mother of all changes to the domestic tax regime in the last few years or so, and I will tell you why. Ever since its announcement during Budget 2022, which is close to 4 months ago already, this topic has generated plenty of debate and comments from stakeholders, be it the industry players like yourselves, people from the professional industries like us, and even the man on the street. But what we're happy to note is that the government has agreed to grant some relaxation to this, to both individuals, Weina has mentioned, and companies, which I shall touch upon along the way. Now, why I mention this to be a significant change is because it affects the fundamental basis of income tax itself, being what falls within the tax net to begin with. Now, to recap, before 1st of January 2022, a taxpayer's FSI was exempted from income tax upon it being received in Malaysia. So, for example, in the case of, let's say, a Malaysian investment holding company, any dividends or interest income received by it from their foreign subsidiaries, those income were typically exempted from corporate income tax when received in Malaysia. But however, this exemption did not apply to resident companies that were in the business of banking, insurance, or sea or air transport. Those companies were taxed on their worldwide income. So in the last quarter of 2021, what happened was that Malaysia was included into Annex 2 of the European Union's revised list of non-cooperative jurisdictions for tax purposes. In a nutshell, the EU regarded the FSI exemption regime of several countries, including Malaysia, as generally being harmful tax regimes. While they acknowledge that such regimes operating on a territorial basis are not inherently detrimental, however, concerns arise where they create instances of double non-taxation, and particularly the concerns was around passive income such as interest or royalties, especially where the recipient has little or no economic substance in country. So countries that were in the so-called Annex 2 were given or committed to either amend or abolish their purportedly harmful FSI exemption regime by the end of this year. So against that backdrop, then we saw the change to the income tax legislation, such that from 1st January 2022 onwards, only non-resident taxpayers are exempted from income tax on their FSI, which is received in Malaysia. Next slide, please. So, ladies and gentlemen, this change will be implemented in 2 phases. During the transitional phase, which runs from the 1st of January to the 30th of June 2022, FSI received in Malaysia during that period will be taxed at 3% on a gross basis. Okay, so I emphasize the word gross because this should mean that allowable tax deductions cannot be claimed against the gross income. So in line with this, the tax authorities have launched a special program for Malaysian residents who have income kept abroad. Basically is to encourage them, so-called encourage them to bring that income back to the home country. So this special program in the local Bahasa Malaysia language is called the Program Kas Permitan Pendapatan or PKPP yang disimpan di luar negara. So in the media release pertaining to this special program, what's good to note is that the tax authorities have indicated that for any income declared under this special program, no audit, investigation or penalty will be imposed on the taxpayer in respect of the FSI that is brought back to the country, as it will be received in good faith by the tax authorities. But that said, we are still waiting for the detailed guidelines on the FAQs from the tax authorities to know how this program will actually be executed. So in the second phase, which is from the 1st of July 2022 onwards, the FSI received in Malaysia by the residents will be taxed at the prevailing rate on chargeable income. So by virtue of chargeable income, it means that any allowable tax deductions can be claimed. Another thing to note is also that while any foreign tax suffered by the resident taxpayer on the FSI received in Malaysia should be claimable as tax credits against their Malaysian tax liability, so that there is no double taxation on the same income. However, the mechanism of how this is to be done is still awaiting or pending further guidance from the authorities, especially how it will be claimed during the PKPP, the special program period, where it's taxed on 3% on the gross basis. All right, next slide, please. Now, as briefly alluded to earlier, an encouraging development is that in a recent media release dated 30th December 2021, further to the joint discussion between the government and the various feedback received from the stakeholders, government has agreed to exempt Malaysian tax resident companies and limited liability partnerships on foreign source dividend income received in Malaysia. Okay, so I mean, at the moment, at this juncture, the exemption is specifically for foreign source dividend income only, and not on all foreign source income received in Malaysia by companies and LLPs. This is subject to what we call substantive conditions that will be prescribed in guidelines to be released in due course by the tax authorities. Also, another thing to note is that, as mentioned by, briefly mentioned by Weina earlier, there is a sunset clause to this exemption at the moment, and it is until 31st of December 2026 only. So all in all, ladies and gentlemen, I would say that this is still very much a wait and see approach, pending the relevant guidelines from the tax authorities to address some key burning questions, such as, I think most importantly, what is the definition of received in Malaysia? Is it as simple as monies being remitted to the bank account in Malaysia? Or does it include instances of indirect or what we call constructive remittances to Malaysia? Other things like, what are the documentation to be maintained by the taxpayer to prove that they have suffered the foreign tax, and when have they suffered it, as well as what I mentioned earlier, the mechanism for claiming tax credits. Rest assured, there will certainly be updates from us or your other professional tax advisors as soon as these details become publicly available. But do bear in mind two fundamental principles, ladies and gentlemen. Firstly is that this applies to proceeds which are income in nature only, and only where it is received in Malaysia by the resident companies. Okay, can we move on to the next slide, please? All right, next slide. Okay, now this second topic also sparked a lot of buzz among corporates when it was announced. So ever since the news of local companies in certain industries earning higher than usual, or some say abnormal profits during the pandemic period, which started close to 2 years ago, there were questions as to whether will the government impose any sort of windfall tax or the equivalent on such companies. And this was bearing in mind, the various stimulus packages, unprecedented stimulus packages announced by the government during the pandemic period to shore up the economy. So against this backdrop came the announcement of this Cukai Makmur, or prosperity tax, and as it is literally translated into in English during budget 2022. So this Cukai Makmur is actually a one-off tax, one-off tax for 2022 only, applicable to companies which do not fall within the ambit of small and medium enterprises for tax purposes. This Cukai Makmur will work in the following manner. So in a way, it's a form of a progressive tax, whereby on the first 100 million of chargeable income derived by the company in 2022, the tax rate is 24%. And then on the remaining chargeable income in excess of 100 million Malaysian ringgit, that is where the Cukai Makmur of 33% will kick in. Okay, so 24 on first 100, 33% on excess. But one thing to note is that in the Ministry of Finance's 30th December media release that I mentioned earlier, they have clarified that FSI received in Malaysia by resident companies shall be excluded from the calculation of Cukai Makmur in 2022. So in a way, sort of maybe a blessing, if you would call it, for the Malaysian companies. Now, as for the SME companies or the other non-SME companies which are not subjected to Cukai Makmur, these groups of taxpayers will be taxable at the prevailing corporate income tax rate. Although the underlying intention of Cukai Makmur is rather obvious, I would say, being a higher tax on companies that generate high income during the pandemic period. However, there are possibly some question marks surrounding how it will be implemented. For example, based on the language of this Cukai Makmur in the Finance Act, it seems to cover all companies that have chargeable income exceeding 100 million Malaysian ringgit, regardless of their industry. And it does not seem to take into account that some of these companies, they have already been earning such high profits even before the pandemic. Or on the flip side, it also does not seem to take into account that some or a lot of companies have actually experienced a steep decline in profit because of the pandemic, but the chargeable income is still in excess of 100 million Malaysian ringgit. So such companies would still be subjected to the Cukai Makmur, even though they are the ones who so-called suffered the most during the pandemic. So again, ladies and gentlemen, very much wait and see approach in the coming weeks and months, whether there will be further clarification on this. Okay, next slide, please. Okay, now this one is on extension of the expiry date for unabsorbed business losses. So previously, the unabsorbed business losses of a company can only be carried forward for a maximum of 7 consecutive years of assessment. Now, as this time restriction first kicked in YA 2019, therefore, during the transitional period, any unabsorbed business losses brought forward to 2019 from the prior years can be carried forward up to YA 2025 only. So 7 years from 2019, so YA 2025, and any excess after 2025 will be disregarded. Now, under the amendment to the Income Tax Act, the time period to carry forward the unabsorbed business losses has been increased to 10 consecutive years of assessments, so 7 to 10. One good thing to note is that this amendment applies retroactively. So what this means is that any unabsorbed business losses brought forward to 2019 can now be carried forward to 2028. Right? So previously 25, now 28. So based on this, ladies and gentlemen, I think we can agree that this is indeed a generous measure introduced by the government to further help businesses recover in the so-called post-pandemic period. Okay, next slide, please. Now, this one is on the extension of the Special Reinvestment Allowance, or RA. So to recap, ladies and gentlemen, RA is a form of additional tax depreciation. Okay, additional tax depreciation granted to companies which have incurred capex on a qualifying project in Malaysia. So qualifying project here relates to either manufacturing or agriculture. And specifically, when it comes to manufacturing activities, the qualifying project must be in the nature of either expansion, modernization, automation, or diversification projects. The RA rate is 60% of the qualifying capex incurred, meaning for every 100 ringgit of qualifying capex spent, the company may enjoy an additional 60 ringgit of tax depreciation on top of the regular capital allowances that are claimable. So all in all, 160% of the capex. But the RA claim is to be set off against 70% of the statutory business income only, and any excess of that allowances can be carried forward for future use, but restricted to 7 consecutive years. The initial RA period is 15 consecutive YAs, beginning from the year in which the first claim was made by the company. The government has actually been quite supportive of reinvestment by Malaysian companies, in the sense that they have granted several rounds of extension of the reinvestment allowance period. So for those companies who have exhausted the initial 15-year period, a special RA was granted for capex, qualifying capex incurred during 2016 to 2018. Okay, so that was the first round of extension granted. Then under the Penjana stimulus package announced in 2020 to encourage reinvestment by companies during the pandemic period, the RA was again extended from 2020 to 2022. Okay, and then in budget 2022, this was further extended to 2024. So all in all, the extension of the reinvestment allowance period under Penjana now covers 2020 to 2024. Okay, so with this, I believe manufacturing companies intending to incur capex over the next 3 years or so should seriously consider their eligibility for reinvestment allowance in order to maximize the tax benefits on the capex that they're going to spend. But that said, ladies and gentlemen, this needs to be done carefully, because we are aware that the reinvestment allowance claims is an area that is quite scrutinized by the Malaysian tax authorities, and there have been several cases which have gone to court on a myriad of issues surrounding the reinvestment allowance claim. Documentation is key. Documentation on the nature or existence of a qualifying project, as well as the qualifying expenditure incurred, is important. All right, can we move on to the next slide, please? Now, this next update is a consequential amendment to the reinvestment allowance schedule in line with this extension under Penjana that I mentioned earlier. This is to clarify that any unabsorbed RA granted under Penjana at the end of 2024 may be carried forward for a period of 7 consecutive years, beginning 2025, and any unabsorbed RA after that 7-year period shall be disregarded. Okay, next slide, please. Now, this is a new section on withholding tax, or WHT, on payments made to agents, dealers, or distributors. Okay, so effective 1st January 2022, where a company is liable to make payments in monetary form to an agent, dealer, or distributor arising from sales, transaction, or schemes carried out by that person for the company, then the company is liable to deduct 2% withholding tax on those payments. Okay, so this applies to payments in monetary form to the agent, dealer, or distributor arising from sales, transactions, or scheme. So I think the first thing that would come to your mind is commission payments. Yes, commission payments are the typical ones, but because the language used is very broad, payments in monetary form. So I think it may go beyond commission. Any form of payments that you make to these people, which is tied to the sales that they make for the company. The withholding tax that is deducted by the company must be paid over to the tax authorities within a period of 30 days of paying or crediting the non-resident. Now, this timeline is a bit different from the existing withholding tax provisions in the Income Tax Act, which whereby the timeline is 1 month upon paying or crediting a non-resident. But in this section 107D, the language used is 30 days. Okay, so it's like has different meanings here. Agent, dealer, or distributor here refers to a resident individual who received more than 100,000 ringgit of payments, whether in monetary form or otherwise, from the same company in connection with the sales transactions or schemes made on behalf in the preceding year. Okay, so we look back at the previous year to determine whether you exceed 100,000 or not, and if you exceeded it, the company exceeded it, then this 107D withholding tax shall apply. Okay, the withholding tax that is remitted to the authorities is actually an upfront account of the personal income tax liability of the recipient. So meaning it will be set off against their actual tax later to determine, whether is there any amount balance left that they have to pay the tax authorities. This section was also rather created quite a buzz amongst players in various industries, most notably the insurance, the telco, where they pay a lot of commission to individual. We are aware that there was a lot of feedback and lobbying happening at the background, and really remains to be seen whether, we have already passed 1st of January 2022, so remains to be seen in the coming weeks whether will the government go ahead with this timeline to implement it immediately, or will they defer the effective date to a much later date? Because a lot of these companies were saying that, look, in order to implement this, they have to reconfigure their systems, etc. They have so many individuals that they have to keep track of. So operationally, it's a challenge for them. So it really remains to be seen. Next slide, please. Okay, if you recall, the government several years back decided to roll out tax identification numbers, or TIN, in an effort to make tax administration and compliance more seamless. TIN is also a feature, something that is used in other countries. So Malaysia then was looking how could they implement it as well. So effective 1st January 2022, the following persons shall be assigned a TIN under the Income Tax Act. Firstly, any person who is accessible and chargeable to tax. Secondly, any person who is required under the Income Tax Act to furnish a tax return. Or thirdly, any person who is a citizen aged 18 years old and above. Apart from income tax matters, the TIN that is so assigned to taxpayer shall also be used for any real property gains tax or stamp duty affairs. Okay, and any person who has already been assigned an income tax reference number on or before 1st of January 2022 is deemed to have already been assigned a TIN. Okay, next slide, please. Okay, tax compliance certification. Currently, there is no SOP in the government's procurement procedure to exclude taxpayers who are non-tax compliant from being awarded government contracts. Okay, so what this means is that even taxpayers who are potentially non-tax compliant may apply and even win government contracts. So effective 1st January 2023, the government is proposing to tighten its procurement SOP such that only tax-compliant taxpayers may participate in tenders for government contracts. And this will be implemented via the introduction of a tax compliance certification, which presumably is a prerequisite document that has to be furnished in order for them to participate in government tenders. This certification requirement is actually not something new. It has already been implemented in other countries around the world. But at the moment, the exact details or content of this tax compliance certification, how to go about getting it, what are the criteria that will be considered, etc., it is still not known yet, and we understand that there will be a pilot project that will be rolled out in the second half of this year. Personally, I see this as a good measure to enhance, of course, transparency and also the level of voluntary compliance among taxpayers. But I think, as we all know, the theory or the policy intention behind it is only one part of the equation. What is important to ensure a good success of this program is robust implementation and, more importantly, unbiased enforcement of it. Okay, next slide, please. Okay, this is my last update, ladies and gentlemen, and this relates to the new powers of the tax authorities to request for the bank account information of taxpayers from 1st January 2022 onwards. Actually, just a few weeks ago, there was a lot of hoo-ha in the news on this topic. Unfortunately, due to a combination of misinterpretation of the law by the public, and also lack of timely clarification from the authorities. I myself received plenty of messages on WhatsApp saying, that now the authorities can secretly ask the banks to provide the bank account details of taxpayers to authorities, and then tax authorities will use the information to impose additional tax on the taxpayers. Okay, so you can imagine that messages of such nature were flying around all over the place. But actually, this is clearly not the case, ladies and gentlemen, and the language of the section 106A is unambiguous on this. The power to require financial institutions to furnish the bank account information of a taxpayer is exercisable for the purpose of making a garnishee order application only and not for any other purposes. Okay, so it's restricted in that sense that it's for garnishee orders only. Now, briefly, a garnishee proceeding is a civil legal process of enforcing a money judgment by the seizure or attachment of debts due or accruing to the judgment debtor. So what this means is that a civil proceeding must have been instituted by the authorities against the taxpayer, and a judgment has been obtained against the taxpayer before the tax authorities can exercise this section to request the bank to provide the bank account details. And again, that is solely for the purpose of making a garnishee order application to the court. Okay, so the financial institution themselves, they are prohibited, specifically prohibited under the law, from disclosing to the taxpayer that they have received such a request from the authorities. And if they breach that secrecy, then the banks, the financial institutions themselves would have committed an offense that is punishable under the Income Tax Act. Okay, so with that, I have come to the end of my presentation. I hope you found it useful. Let's see if there's any Q&A. Okay, seems like there's none at the moment, but no worries, ladies and gentlemen. I, along with the other fellow speakers, are still until 5. So if there's anything you want to ask, just type it in and we will respond. All right. Other than that, thank you very much. Over to my indirect tax partner, Mr. Senthuran.
Thanks, Boon. Hi, everyone. So moving on to indirect taxes. Now, before I get into the updates, just a quick summary in terms of the current situation. Now, many of you would have sort of heard the speculation as to whether the GST would have been reintroduced to Malaysia. You know, we had a brief flirtation with the GST VAT system a few years ago before it was abolished. Again, there was nothing in the budget. There was plenty of speculation. Again, sort of to share my thoughts around that, we're unlikely to see a return of the GST in the current economic climate. And this is sort of consistent with what we're seeing globally around indirect taxes. A lot of the global indirect tax regimes, jurisdictions, what they've done is provide a lot of concessions, provide a lot of rate reductions over the pandemic, because again, these taxes are transaction taxes and they significantly impact consumption. And given that consumption is dampened and you know, incomes were down, governments globally, you know, took the action of really trying to reduce indirect tax rates and provide lots of concessions there. So Malaysia was no different. Now we're sort of in that period of recovery, and I think what we've seen again in a number of jurisdictions globally is that as countries come out of the pandemic, we're seeing an upward movement on some of those rates. So it's certainly possible down the track, you know, as the Malaysian economy recovers, that, you know, we may see some serious considerations as to how the indirect tax system and the overall tax system is structured. But I certainly don't see it in sort of the near future. But because of that, you know, what we've seen from a sort of a fiscal position around indirect tax collections, they have been significantly reduced over the last couple of years. So the figures that are coming out from Ministry of Finance and the Royal Malaysian Customs Department are that you know, indirect tax collections are much lower than they were in 2019. So they're lower in 2020 and even lower in 2021. And again, this is representative of all the concessions and exemptions that have been given, and I'll touch on some of those, you know, concessions to various industries that have been impacted, such as automotive, hotels, and so on. So whilst you know, the government sort of been limited in its ability to sort of widen the scope of these taxes, they have announced some revenue raising measures, and they've also announced some additional or continuation of existing concessions. So I'm going to sort of quickly touch on those. If we jump ahead a couple of slides to the first sort of revenue raising measure, which is the Special Voluntary Disclosure and Amnesty Program. So for those of you who are operating in Malaysia under the indirect tax regime, you may know that there has never been any form of voluntary disclosure program that's been run by Malaysian Customs. So if you make an error under any of the indirect taxes, and you voluntarily disclose that to the authorities, even without an audit, their practice is they impose a penalty. You can then subsequently appeal that penalty, and then it's all decided on a case-by-case basis. But there is no sort of offer of amnesty or concession for doing the right thing or offering to do the right thing. So the authorities have made a sort of a significant step by announcing a one-off program, which they're calling the VA, or Special Voluntary Disclosure and Amnesty Program. And it addresses two areas. So one, it looks at errors that have, you know, that taxpayers are aware of, but has not been detected by customs either through audit or their inquiries. And then there is also an amnesty in relation to errors that have been identified by customs during the audit, and for those ones where they've actually completed the audit and issued a bill of demand. So they're quite significant and quite unique concessions, quite different to what I've even seen elsewhere globally. So I'll touch on the concessions in the next slide. So on the left-hand side, you see these are the taxes that are covered. So it's quite broad. So it covers virtually all the indirect taxes that are administered by customs, including, you know, sales tax, service tax, GST, the former GST, and import duties. There are two phases within this regime, voluntary disclosure. So sorry if you just hit next couple of times. So the first phase is 6 months. It starts from January, so last week to the end of June. So if you make a submission or an application under this program over that period for any errors under these taxes, customs will waive 100% of the penalty. So you don't have to pay any penalties whatsoever. And penalties under these regimes can be for sales tax, service tax up to 40%. For import duties, some of them can even be over 100%. So that can be quite significant. The other very unique aspect is the customs are also willing to waive a portion of the actual tax that's due. So, if you owe $100, you may only have to pay 90, or you may have to pay 70. So you're actually saving money, even though you've underpaid tax. So there's two periods. There's first period of 6 months, and then the second period of 3 months, which has a sort of lower concession. So as I said, this is a one-off, and there's a number of conditions which I'll touch on in the next slide. Move on to the next slide, please. So one of the critical aspects is that it requires the matter to be settled within that time period. So if you submit your application and you make a payment within that first phase, so if you recall, the payment period was phase one was between January and June. Provided that the whole matter is closed and you've made payment by the end of June, you're eligible for the phase one incentive, which is the 100% and up to 30%. Once, if you make payment after 30 June and before the end of September, then you fall under phase two. And then if payment happens after the end of September, then you pretty much are not eligible for anything. And so it becomes critical then. So if you have potential disclosures, or you're not sure, and if you want to investigate internally, or get someone to come in and have a look just to make sure that everything is in order, there's a very limited time, because it's not a case of just, as long as you get the application in through the door, then you're eligible. You really have to have everything settled, including payment, by that end of that time period, in order to be eligible. Now, there is an application fee, what they're referring to, a compound amount. So, if your liability is below, so if you want to disclose a liability below 100,000, you'd have to pay 500 ringgit per application. If it's above 100,000, then it's 1,000 ringgit per application. So the application is really per entity. So if you say you have a particular registered entity and it's it wants to make a disclosure over multiple years or multiple periods or multiple taxes, you should be able to do that across one application. Next slide, please. So a few of the benefits here. So one, penalty and tax remission. Having advised on indirect taxes in Malaysia for quite some time, it's very difficult to get full remission of penalties. It's very rare, and it requires going through a lot of hurdles. So to have something like this offered on the plate, it's very generous. And to add on that, the potential to actually get some of the tax back as well. One of the critical things, going into this when they announced it, and some of the doubts that we had is, how would customs actually react? Operationally and procedurally, you make an application, can you really trust, that's where it's going to end? What they've outlined to us in terms of the procedure is that essentially once an application is made, they're not going to request for detailed documents. They will accept it in good faith. And it's essentially, they just need to verify that that they understand what the amount is, and that it's documented in their system. So once that amount is sort of determined, then they will require payment. So it's not going to result in any form of verification exercise or any form of audit. All it requires is disclosure of the amounts and an outline of what the error was. Based on our discussions with customs, they're not even going to ask for agreements or detailed documents. That being said, if we were advising our particular client to put an application in, we would always recommend putting in as much information because again, the best thing is to make a full disclosure so that there's no ambiguity on the facts or anything like that, so that customs have all of the information, that again should mitigate anything going forward. One of the things that they have stressed is that they will not conduct an audit as a consequence of the voluntary disclosure. On the flip side, though, is what they have told us is that at the end of September, they are going to roll out a significant audit program, and that they will be auditing most taxpayers. So so I think this is sort of the carrot and the stick approach. So if you don't take the carrot, then they are going to come with the stick. And a few of the things that they have suggested is in this period, in this 9-month period, they will be writing letters to taxpayers who they've identified already in their audit list to let them know that they will be audited as later in the year as a way of encouraging them to participate in this program. I think that's one thing that I want to stress is that once the end of that 9-month period, we're unlikely to see this continue. And so again, if you're caught during audit, penalties can be quite significant. Next slide, please. Again, I'm not going to go through this in significant detail, but what this table highlights is the different scenarios under which you will get full remission of tax or full remission of penalties. So you'll see it's fairly consistent full remission of penalties in the phase 1. You'll get 30% tax if you are a company who is not registered yet and you haven't done anything. If you are a company that's registered but has made some errors, then you're most likely going to be eligible for a 10% reduction of the tax. Now, if you're one of these companies who for some reason has not registered but has collected tax, then you are also eligible for 10%. But the 30% specifically on the remission of tax is only really applicable to those companies who've not yet registered. Next slide, please. So I think just to re-stress the key features here, essentially that there's no audits going to be conducted. Customs will accept everything in good faith. It's very critical that all the payments have been made within the time frame in order to be eligible. Next slide. As either in progress or the audit is completed, then you're going to fall under the Amnesty program. Now, if you haven't been audited, you haven't had an audit assessment, then you're under the Voluntary Disclosure program. So there's slight differences around the procedural aspects, but the eligible benefits that I discussed earlier will be the same. Okay, so that's all on the Voluntary Disclosure program. I'm going to talk about some of the other key developments. Next slide, please. Service tax on goods delivery services. So currently, service tax only applies on delivery services where the service provider is licensed under the Postal Service Act. So this now expands the treatment to cover all forms of delivery services. So, so essentially from 1 July, all forms of delivery services will be subject to service tax, excluding food and beverage delivery services. And this includes the delivery services that are provided by e-commerce providers. So if you're buying off a platform, you're buying off a website and you're getting goods delivered to you by a third-party delivery company, and there's a fee attached to that, that fee will be subject to service tax from 1 July 2022. But to stress again, food and beverage, like, so ordering from Grab or Food Panda, where there's a delivery charge, that should not be subject to service tax under these expanded rules. Next slide, please. Sales tax on low value goods. This one is another one that impacts e-commerce industry. We've seen this as part of a global trend. Coincidentally, the EU and the UK have sort of implemented these provisions in the past year or so. But in our part of the world, Australia and New Zealand have already implemented it. Singapore have announced it with a view to implementing it next year. What this covers is if you're buying goods and getting them shipped from overseas into Malaysia, or any other country for that matter, if you're living in a particular country, only goods over a certain value are actually taxed at the border. There's a certain threshold where it's just not cost effective to impose tax and impose customs control. So in Malaysia, that's 500 ringgit. So anything below 500 ringgit that's shipped by an air courier, that does not go through border control. That just sort of passes through because it's just not feasible. Now, given the explosion of the e-commerce industry, there's a lot of tax that's not being collected from the sale of these goods. And so what we've seen is jurisdictions globally are now implementing sort of frameworks and rules and being structured both developed by the OECD to collect tax. And so Malaysia is now looking to implement this and introduce this from 1 January of next year. The unique aspect of this is that all the other countries that are doing this operate a GST and a VAT system. Malaysia is the only country that doesn't have one that is looking to implement it. So it is going to be somewhat different to what we do here. So how the Malaysian rules are likely to work and what we understand how it will work is if you purchase goods from a platform or from a seller, and those goods are shipped from overseas to you in Malaysia. So if you're a Malaysia customer, whether that's a business or an individual, does not matter. And the value of those goods is below 500 ringgit, then the seller of those goods will impose 10% sales tax on those goods and collect that 10% sales tax from you. So for those of you who are familiar, if you log onto one of those marketplace platforms, you decide that you want to buy, buy an item with it, but you want to buy a small, a pair of speakers or something, and it's below $500 for your computer, or a webcam, and you order it at that point of sale when you're about to pay. And it outlines the price and the shipping and the logistics costs. There will now be a line entry with sales tax and 10% sales tax. So that will be the critical difference that we'll see. Okay, but that's going to be implemented from 1 January 2023. Now, very small changes that I'll touch on next. If we just go to the next slide. Very high level, this is a windfall profit levy that applies on the sales of palm oil. What we've seen here is not really revenue raising, but we've seen a standardization of the rates between East Malaysia and West Malaysia, so that there's a more consistency around 3%. But again, this is just a very minor change there. Next slide. We've also seen additional sort of excise duty on liquid or gels around the East and we previously had it on liquids or gels on nicotine. Now we've also got it expanded to e-cigarettes, including vape. Again, this is a sort of sin taxes that we're sort of seeing the government sort of looking to discourage this kind of activity. Next slide, which is another sin tax we've got to cover as well, which is the excise duty on sugar. So again, what the government has done is expanded the scope of these these provisions so that now it also includes those sugar sweetened beverages like the 3-in-1 coffees, 3-in-1 sort of those pre-mixed drinks. So that the price of those will have gone up. Next slide. So some of the concessions that have just been extended or introduced. Stockbroking services. So the government expanded a couple of years ago to apply service tax on broking services. From 1 January of this year, service tax will no longer apply on any brokerage services that relate to the trading of shares on Bursa. It's only limited to shares, so any other kind of trading activity continues to be subject to service tax. So it's an exemption, it's a narrow one, but it will impact most brokers. Next slide. You would have also heard about this. There's some tax incentives for the EV industry, so electronic vehicles. And so what we've seen here is that there's a full import duty exemption on locally assembled vehicles. There's also some benefits on a more limited benefit for about 1 year for those completely built up ones, or the fully built up vehicles that are actually imported in, but a longer concession for those ones that are assembled here. Next slide. We've also seen an extension of the existing exemption that was announced during the pandemic for the importation of vehicles. So that's been extended another 6 months. So for those of you who are holding off buying your car, you've got another 6 months to get there to sort of take advantage of the concession. Next slide. Two extensions of exemptions as well. One is the tourism tax exemption. So if you're a foreigner in Malaysia, you're quite familiar with this. If you stay in a hotel, you've got to pay 10 ringgit additional per day, per night. Per night, per stay. That sort of, there was an exemption that was given until the end of 2021. That's been extended till the end of this year, again, to sort of help the the hotel industry. Related to that, there's another one on the entertainment industry as well, which is in the next slide. Some of you might be familiar that, or maybe aware, if you go to a theme park or cinema in KL, you're actually paying an entertainment duty. So that's an exemption, again, was given until the end of last year. That's been extended another year as well. So you'll see again, going in that broad theme, some concessions there to help various industries that have been significantly impacted, but there hasn't been much around revenue raising other than that SBDP and a couple of areas. With that, I'll hand it over to Tamas to talk about transfer pricing.
Yes, thank you, Sen. So our last topic for today is the transfer pricing, and being mindful of the time, let's get started on. Yes, so there are some regulatory changes. These are not part of the 2022 budget. These are effective 2021. But if you have any ongoing transfer pricing audits, or if you get audited from now on, these new updated rules will apply. So let's get started. There's three main areas of change. The first one is that, up to the end of 2020, there was no penalty if you don't prepare your transfer pricing documentation, except a small administrative fine for not complying with a request. But that was relatively significant. Unfortunately, from now on, there's a 20 to 100,000 ringgit penalty for each transfer pricing documentation not submitted. So if you have a group with several entities in Malaysia, this can come out to be a pretty large sum in the end. Now, the next one is a new penalty on the transfer pricing adjustment. So before this change, the penalty was charged on the additional tax payable, and they changed this to the transfer pricing adjustment. So in effect, the tax base increase will be the basis. In line with that, the rate has also been reduced. So it was 30% and up before the changes, and now it's 5%. So if you are in a fully tax-paying position, this new penalty may even be less than before, but there are a number of implications to this change in the method of calculation, which I thought would be important to highlight. So because this is now the transfer pricing adjustment, For example, if you are in a, or if the company is in a loss-making position and it remains loss-making even after the transfer pricing adjustment, there may still be a penalty. While before this change, the increase in tax payable was zero in effect, so there was no penalty. Also, with the penalty being linked to the TP adjustment, for example, companies under incentives can receive a penalty as well, or non-taxable income may also be subject to this. Now, the last change that I wanted to highlight is the non-recognition of related party transactions. So this new regulation, in effect, gives the IRB the power to disregard or recharacterize controlled transactions where the structures lack substance or the substance differs from the form, or if it's deemed a commercially irrational agreement. Now, one example that I wanted to bring up here is, for example, in the case of loans. So if the Malaysian subsidiary, for example, receives a loan and deducts interest, then the IRB, based on all the facts and circumstances in an audit, they may deem that this loan was quasi-equity and not a loan in nature. And so if this transaction is disregarded, then it means that the interest becomes non-deductible. This is just one example, but there could be many forms of this rule being applied in practice. Now, I wanted to highlight our audit experiences as well. And the first thing I wanted to cover is the data sources. So what is the IRB looking at to determine if a company gets audited? So the first one and the most obvious is the tax filing. So all companies disclose a lot of information in the annual filing. And so that is the primary source. And then there is the country by country reporting, which for most multinationals, so it's filed in the, let's say, the European headquarters, but this data is shared across the various tax authorities. Also, the Malaysian IRB sometimes sends this form M&E. I would believe many of you may have received it already over the past few years. So in addition to the annual tax filing, the IRB uses this form to request additional information, which helps them in the risk assessment and the selection for audit. The M&E form, I'm not sure if any of you have received the latest version of it. There are some changes to the form, and we believe these may be indicative of what the IRB is planning to look at, which links us to the focus of the TP audits with later. So in the form M&E, there are some questions regarding restructurings and intangibles. So this is part of the reason why they are highlighted as focus areas. The last one is the information exchange. So various overseas tax authorities and different Malaysian authorities exchange information, and that could be used for selection for audit. Now, in terms of the focus of the TP audits, besides the restructuring and intangibles that I mentioned before, we see a lot of audits linked to incentives. So, of course, typically after the incentive period, there are some practices that we have seen on the market which are clearly like where we understand why the IRB is paying attention. So, for example, if a company during the incentive period reports high profits but zero or lower taxes, and then once the incentive period ends and the profitability quickly drops during the period when they would otherwise be paying taxes. So the IRB likes to investigate what's the reason for the drop of the profitability after the incentive period. And of course, the other focus of these audits is to see whether the company complied with the incentive criteria. The last focus area is the intragroup financing. We see a lot of audits focusing on intercompany loans, corporate guarantees, and so on, and also the earnings stripping rules. There are a number of risk indicators that the companies can check for themselves. So the first one is the consecutive loss-making or fluctuating profitability companies. And this applies especially to the subsidiaries of multinational groups, where in most of the cases, the local entity is set up as a limited risk entity. So for example, limited risk distributor or contract manufacturer in Malaysia. And so based on the OECD guidelines and in general, the transfer pricing regulations all across the world, these limited risk entities are expected to make pretty solid routine profits without much fluctuation, unless there are some extraordinary circumstances. But so if these entities are making losses or they have a fluctuating profitability, they can expect the IRB to investigate the reasons. Yeah, so this is also linked to the high variances in the CBCR or the high non-taxable profits. Of course, if there is no TP documentation prepared, then it's difficult to justify that the company complies with the local regulations. Now, the last topic that I wanted to touch on is how to prepare for any IRB audit. There's two main groups of actions that any company can take. The first one is protective, and the second is the proactive. Of course, what we are getting at in the end is that the proactive is always better than protective. So if any company gets an audit letter and then there's some adverse findings, the first course of action that they can take is domestic appeal. If it's an international, like overseas transaction, then a mutual agreement procedure, an MAP, is also a possibility, where the Malaysian and say the French tax authorities agree on what should be the transfer price. And Malaysia, so this is for quite high value transactions in general. As you can see, the latest statistics that we have are from 2019. Malaysia had 8 MAP cases for transfer pricing. So there's not a lot of these. And one of the reasons for this is that the average time for settlement is still above 30 months. And even the target of the IRB is 2 years. So this is a very lengthy and also it can be an expensive procedure. Now, the proactive methods of dealing with the transfer pricing risk. The first one is advanced pricing arrangements, so APA. In this case, the taxpayer can approach the tax authorities to agree on the pricing for a transaction for the future. So this is ideally concluded before any transaction starts. So once this is settled, then it's binding to both the taxpayer and the tax authority. So this is the most secure way to handle any transfer pricing risk. And then for like a more one-sided Malaysia focused approach, there is an opportunity for a voluntary disclosure, similarly to what Sen was explaining before. There are a number of advantages. Of course, you get a much friendlier approach if you approach the IRB and declare that you want to make an adjustment. There is a quicker turnaround. in our experience, if everything is fine with the submission and there's no additional requests, then it can be concluded in 2 months. So that is relatively fast. It is also cheaper. So the 5% surcharge that we were discussing before, so it can be reduced to 3% in most cases, and 2% if if you are lucky. Let's put it this way. So this may be something to consider. Now, the main difference is that the APA is forward-looking, and the voluntary disclosure is for tax periods in the past. So that is the main difference between these two proactive approaches. Now, that concludes my part of the presentation. Thank you for your attention. And yeah, let me check if there are any questions in the chat box. Okay, I don't see any, but if anyone has any questions on the transfer pricing, or well, for that matter, any other parts, then please let us know. Okay, otherwise, Tina, I think.
Yeah, I think all the information given by Deloitte was very complete. We don't have any questions from our members. Mr. Lozak, maybe some final words before we end the webinar.
Yes, Tina. Big thanks to our Deloitte team for their input. I have learned a few things today, and of course, just to remind our members that the Deloitte team, as well as the MFCCI team, is ready to assist and advise on most of the matters that has been mentioned, and that I think both companies, Deloitte and MFCCI, look forward to be of assistance and help to our members, and wishing everybody a good start of 2022. A quick reminder to our members that next Thursday we will have our Happy New Year, our kickoff 2022 gathering, which will take place at Sofitel at 7 p.m. So this coming Thursday, 20th of January. If you have not registered yet, please do so, and we look forward to see you for this first physical encounter. Thanks again for your participation. Looking forward to see you all this year, and all the best for 2022. Merci beaucoup.